Imagine buying a business, right?
Mm-hmm.
And um, the primary asset isn't a factory. It's not a warehouse stacked with inventory.
Yeah, no physical widgets sitting around.
Exactly.
Yeah.
And it's certainly not, a piece of intellectual property like a software patent. The main asset is simply this invisible promise stretching 10, 15, or even 20 years into the future.
Right, it's completely intangible.
Yeah, so today we are looking at a company that has roughly 43 rupees per share just sitting in the bank.
Mm-hmm.
Yet the market is demanding you pay 90 rupees just to own a single share. And that 47 rupee gap, it is made entirely of those invisible long-term promises.
And, bridging that gap between the visible bank account and the invisible market price, that is where the real financial detective work happens. So welcome to our valuation series.
The place where we dig into the actual numbers.
Exactly. Our mission is to forensically break down listed companies on the Colombo Stock Exchange using strictly their annual reports. So there are no insight tips here. We don't do rumors. We don't make blind guesses.
Just the data.
Just the data. And today's deep dive focuses on Softlogic Life Insurance PLC. The ticker is AAIC.
I have to admit, valuing an insurance company feels entirely different from looking at a standard retailer or a manufacturer. It actually makes me a little nervous, to be honest.
It is definitely a different beast.
Right, because with a normal company, you look at the cash, you look at the debt, you count the widgets they sold, and it mostly makes intuitive sense. But with life insurance, the product they sell is essentially a liability.
Yeah, they are taking cash today.
Right, in exchange for a mathematical probability that they will have to pay out a massive sum of money 2 decades from now. It's like reading a different language.
It requires a completely different analytical lens, for sure. And before we start calculating intrinsic values, we really have to establish a very firm reality check regarding life insurance valuation.
Okay, lay it on me.
It is not a hard science. It is a highly structured set of assumptions. Every single number we are going to model in this deep dive depends on inputs that just cannot be fully verified from public data alone.
Because we are fundamentally dealing with the future, right? And, well, the future hasn't happened yet. We are guessing how long people will live, what interest rates will do.
Exactly. And to compound that uncertainty, AAIC does not publish a formal embedded value report.
Which is usually standard, right?
Right. In the industry, an embedded value report is a standardized metric where management explicitly tells the market what they believe their future profits are worth. But without that document, every figure we discuss today is a proxy estimate. We are building this entirely from the disclosed financials in their 2025 integrated annual report for the group.
Wow, okay. So we're really building this from scratch.
We are. And to understand how sensitive this math is, if we just tweak the assumed discount rate, the rate at which we value future cash flows, our estimated per share value can swing by 188 rupees.
Wait, really? 188 rupees just from tweaking one rate?
Just one rate.
Yeah.
2 highly credentialed analysts could use this exact same annual report, run their own models, reach opposite valuations, and both technically be correct based on their own assumptions.
That is wild.
So as you listen, keep in mind that this deep dive is purely for financial education. It is not investment advice. You must do your own research and consult a qualified advisor before making any investment decision.
Well, let me push back on that premise, though. If a tiny change in a discount rate swings the value by almost 200 rupees, and 2 analysts can look at the same data and get completely different numbers, why bother building the valuation model at all?
It's a fair question.
I mean, if it relies so heavily on assumptions, aren't we just doing complex guesswork?
Because a structured estimate with highly visible assumptions is infinitely more useful than a blind guess with hidden ones. If you don't build a model, you're essentially just staring at a stock chart, buying a ticker symbol and hoping the line goes up.
You're just gambling at that point.
Exactly. By doing this exercise, we expose the mechanics of the engine. We show you the exact inputs required to justify that 90 rupee stock price.
Okay, I see.
Once you see the math, you can decide for yourself if you believe the market's assumptions are too optimistic or too pessimistic.
We are mapping out the territory, so we know what we're actually buying.
Yeah.
And if we look at the map for AAIC, going back to what I said earlier, the book value is 43 rupees per share, but the market price is 90. Why is anyone paying double what the assets are worth?
Because life insurers simply cannot be valued by book value alone. They have 880,706 customers who have signed contracts generating income for the next 10 to 20 years.
Which doesn't show up on a standard balance sheet.
Exactly. It's invisible on the balance sheet, but the cash flow is very real. And by the end of this deep dive, you will know exactly what AAIC could be worth and which assumptions drive that conclusion.
Perfect.
Oh, and a quick note, if this kind of forensic analysis is what you want more of, make sure to subscribe to Optivest Investing Sri Lanka. Every time we read the reports so you don't have to guess. Hit subscribe. Let's continue.
All right, so before we even touch the valuation assumptions, we have to look at the historical track record. You don't just assign a premium valuation to a company that's stagnating, right? We need to see if they've earned the right to be priced as a high-growth asset.
Right, and the 5-year evidence from the report is pretty staggering. Let's look at their gross written premium, or GWP. This is basically the lifeblood of an insurer, the total amount of money customers are paying them.
The top-line revenue, essentially.
Yes. In 2020, their GWP was 13,200 million rupees. By the end of 2025, that figure reached 40,075 million rupees.
Oh, wow. So that's a massive jump.
It's essentially a 3x increase in just 5 years.
But I always try to benchmark those numbers against the broader industry. Because if the whole sector is booming, a 3x increase might just mean a rising tide is lifting all boats, you know?
Fair point. But the overall insurance industry grew at about a 14.5% compounded annual growth rate over the decade. AAIC grew at nearly double that industry average.
Okay, so they aren't just riding a macro wave. They are actively taking market share away from their competitors.
The market share data absolutely confirms that. In 2020, they held a 7.5% market share, which put them in 5th place. By 2025, they captured an 18.4% market share. They vaulted all the way to 2nd place.
From 5th to 2nd in 5 years. That's huge.
Yeah, and they are the only life insurer in the top 5 to consistently gain market share every single year over the past 5 years.
But see, this brings up a massive red flag for me.
How so?
Well, in highly competitive industries, the easiest way to steal market share is to just buy it. You throw massive amounts of money at marketing. You pay exorbitant upfront commissions to poach agents.
Right, you get bloated.
Exactly. You get a huge revenue number on the top line, but your profit margins completely collapse. Did they just buy this growth?
The operational metrics actually refute that theory. If they were blindly buying growth, their expense ratio, which is their operating expenses as a percentage of premiums, would be skyrocketing.
And did it?
No, it actually fell. It went from 23% in 2020 down to 17.2% in 2025.
Wait, it went down?
Yes. They're growing incredibly fast while becoming leaner relative to their size.
So they're bringing in 3 times as much cash, but spending a smaller percentage of it to run the business. That kind of operational efficiency has to be doing incredible things to the bottom line.
It is. Their profit after tax hit 4,680 million rupees in 2025. That's up from just 847 million in 2020. And that profit drove a return on equity of 39%.
A 39% ROE is exceptional by any standard. Most banks are thrilled to hit 15%. But for life insurance, profit isn't just about getting the customer to sign the initial paperwork. It's about keeping them.
Exactly.
Because if a customer cancels after year 1, the insurer usually takes a loss, since they've already paid the agent's commission and the medical screening.
Right, you're talking about persistency. And that is arguably the most critical metric for long-term health. AAIC's year 1 retention improved from 78% in 2020 to 86% in 2025.
Okay, so customers are actually staying longer.
Yes. So the track record is genuinely strong.
It is. And that track record is what makes the valuation assumptions we're about to make defensible. Not guaranteed, obviously, but defensible.
Precisely.
So let's get into those assumptions. How do we actually bridge the gap between that 43 rupee book value and the 90 rupee market price? I think we need to break this down. Let's use the framework of the 3 jars.
The 3 jars is a perfect way to visualize it. Let's start with jar 1, which is the easiest to verify. This is the adjusted net asset value, or ANAV.
Right.
This is the baseline equity the company owns today. It's 13,668 million rupees. You divide that by the shares, and you get exactly 43 rupees per share.
Right, so jar 1 is basically what's in their wallet and bank account right now. If they stop doing business today, close their doors, this is the baseline.
Exactly. But they aren't closing their doors. They have those 880,706 existing customers paying premiums. And that brings us to jar 2, the value of in-force business, or VIF.
I like to think of jar 2 like an orchard of mango trees they've already planted. You know, the fruit isn't in the wallet today, but it's going to predictably drop fruit for the next 10 to 20 years.
That's a great analogy. Now, To value that future fruit, we have to account for the time value of money. It's like a fixed deposit. A rupee earned 10 years from now is worth less than a rupee today.
Right, inflation and opportunity cost.
Exactly. So if we take all those future profits from those existing policies and discount them back to today's money, if we assume a 14-year average policy duration and apply an 11% discount rate, JAR 2 comes out to roughly 230 rupees per share.
Wait, pause. 230 rupees a share just from the existing customers? That single jar completely blows past the 90 rupee market price.
It does. But remember, that relies entirely on whether you agree with that 11% discount rate, which we will stress test in a minute. But let's finish the framework first.
Okay, what's jar 3?
If JAR 2 is the existing trees, JAR 3 is the franchise value. It's their ability to plant new trees, future growth.
But valuing customers who haven't even walked through the door yet. I mean, that seems incredibly speculative.
It is, but we measure it using the value of new business margin, the VNB margin. It essentially asks, for every new premium brought in, what is the present value of the profit over the life of that policy?
Okay.
For AAIC, their VNB margin sits between 15 and 22%. We also know their annualized new business premium grew by 39%. If we apply a conservative 10x multiple to that new business, JAR 3 adds another 62 rupees per share.
Okay, let me do the math here. Jar 1 is 43 rupees. Jar 2 is 230 rupees. Jar 3 is 62 rupees. You add all three jars together, you get a total appraisal value of 335 rupees per share.
That's the model's output, yes.
But the stock is trading at 90. That is a massive, massive disconnect. The market is essentially pricing in severe weather risk for your mango orchard.
Absolutely. The market is deeply pessimistic.
Well, let's play devil's advocate then. Let's stress test this, because trees do suffer from bad weather. Before we look at the risks, what are their built-in defenses?
They have a strong buffer. Their underwriting operating profit is 10,702 million rupees post-tax. That's 7,491 million. So the core business of pricing human risk is highly profitable. Furthermore, their capital adequacy ratio, the CAR, is sitting at 245%.
And the regulatory minimum is what, 120%?
Exactly, 120%. So they hold more than double the required capital buffer. It's a huge financial shock absorber. But the real weather risk for a life insurer isn't usually mortality claims. The silent killer is interest rates.
That makes total sense, because life insurers take in premiums today, and they have to invest that money in the markets to ensure they can pay out a guaranteed sum a decade from now.
Right.
They're basically massive investment funds attached to a mortality risk calculator.
They are. And AAIC generated 7,571 million rupees in investment income in 2025. That's a very healthy 14.9% yield. But if local interest rates drop sharply, the new premiums they collect, plus any maturing bonds, have to be reinvested at much lower rates.
Which directly squeezes the profit margins.
Exactly. Let's quantify it. What if rates drop to 8%? They have about 26,014 million rupees in assets that would reprice. Now, they protected 32,077 million into long-term bonds till 2028 and 2031.
Oh, that's smart.
It is, but even with that protection, an 8% rate environment would cause their annual income to fall by roughly 1,083 million rupees.
Taking a billion rupee hit is a massive drag. But wait, valuation has that really counterintuitive mechanic, right?
The discount rate natural hedge?
Yes, because if interest rates drop to 8%, the broader market's required rate of return also drops. So that discount rate we use for JAR 2 falls. And mathematically, a lower discount rate actually increases the present value of future cash flows.
You nailed it. The drop in actual cash is partially offset by the lower discount rate applied to the remaining cash. And this brings up the massive debate between global and local investors. Well, a foreign investor looking at Sri Lanka might demand a 15% global discount rate because of the perceived risk. But a local investor might use a 9 to 11% rate. Using a 15% rate drastically shrinks the present value, moving the total appraisal much closer to that 90 rupee market price. Same company, different value, both valid.
Okay, let me introduce another storm cloud. Mergers and acquisitions. AAIC acquired Alliance Life for 1,426 million rupees. Now, acquisitions always look great on paper, but integrating two massive financial institutions is usually a nightmare.
It can be. Integration risk destroys a lot of shareholder value.
Right. You get colliding IT systems, clashing cultures. Could this be a distraction?
It's a risk, but early data shows the new subsidiary's expense ratio actually dropped from 48% down to 29%.
Wait, from 48 to 29% in just a few months. That sounds like they were taking a chainsaw to the headcount.
Well, it's aggressive, yes.
If you slash staff that quickly, you risk breaking operational capacity. Customer service gets awful. And if policyholders get frustrated and cancel, your persistency drops. And if persistency drops, the future value vanishes.
That is a very valid concern. Cutting costs is only half the battle. But the true test will be asset management reinvesting the subsidiary's short-term assets in this lower rate environment without dragging down the parent's overall 14.9% yield.
All right, let's pull all this together into a verdict. We have the hypergrowth, the three jars, the interest rate squeeze, and the integration risks. What does the final model look like?
Let's look at three scenarios. In a bear scenario, a harsh 20% discount rate and a VNB margin dropping to 10%, the value sits around 148 rupees per share.
Okay.
In a base scenario, 15% discount rate, 15% margin, it lands at 248 rupees. And in an optimistic local scenario, 9% discount rate and 22% margin, it shoots up to 336 rupees.
But the market price is 90 rupees. Even in the absolute worst-case bear scenario, the intrinsic value is mathematically way higher than the current stock price.
It is. But there is one final caveat. Starting in January 2026, the industry shifts to the SLFRS 17 accounting standard.
Wait, how does an accounting rule change the actual cash?
It doesn't change the cash, but it drastically changes the timing of when profits are officially recognized. SLFRS 17 forces insurers to spread out profit recognition evenly over the life of the contract.
So no more fret-loading profits.
Exactly. It could cause short-term fluctuations in reported earnings. The market hates uncertainty, so investors might be waiting to see the first full year of SLFRS 17 results before committing capital.
That makes perfect sense. Let me try to distill this entire analysis into three clear takeaways for you, the listener. First, AAIC has vastly outpaced the broader industry, vaulting to the number 2 spot with an 18.4% market share.
Spot on.
Second, valuing them requires looking past the 43 rupee book value and building a model to capture the future profits of their existing policies. And third, the biggest threats to that value are sustained low interest rates and potential integration friction with their new acquisition.
That is the perfect summary. The inputs are visible, the mechanics are clear, and the risks are identified.
I want to leave you with one final thought to mull over. AAIC has sprinted past the middle of the pack to reach second place. But in any market, taking market share from the undisputed number 1 player is exponentially harder than beating the middle tier. Has AAIC reached its natural ceiling? Or are we looking at the future market leader?
That is the million-dollar question. This is Optivest Investing Sri Lanka. We read the report so you don't have to guess.